Even if you don't have much skill or education, you can still get rich by stepping into stock. Stocks are better approached as a long-term plan. Is it possible to get rich fast with stock? Yes and no. It depends actually. But before we advance any further, I really want to welcome all of you to the Money Masters. Please go ahead and subscribe to the channel and like the video and become a part of the Money Masters. The part of getting rich with stock depends on a few factors, such as how much are you starting with? Are you able to keep your money in stock for the long term or not? But the most important factors are knowledge, sophistication, and experience. Psychology of the market is also the main reason behind the success and failure of most investors. If you don't have much knowledge about investment into the stock market, you should go with long-term investments. Before getting started with details about stock market investments, we need to understand what is stock. Stock, or share, is the share in the share capital of the company. Let's take an example of a big company as a cake. The cake is your company, and the small piece is a share. Owning a share is equivalent to owning a part of the company. The larger the amount of shares you own, the more power you have in making decisions. For example, if YouTube had 10 million shares and you buy 1 million of them, then you are the owner of that part of the company and you are able to make decisions according to your shareholding power stated in the company memorandum. It's very easy to enter the market. However, making money on a consistent basis is very difficult. We need to practice to become successful. Just like practicing how to play defense in soccer, we need to practice how to save money or how to avoid losses and then money management and risk and rewards. Let me tell you a few of the most important factors to become successful. Number 1, right investment. The longer you invest your money and keep it into stock, the more money you will earn. Assume you're 19 and you're offered to buy shares from 10 different companies. One of them is Microsoft. Microsoft was not that popular at the time. But somehow, due to inspiring views of the company in future, you agreed to purchase the shares in the company and purchase the shares of $10,000. That investment would be worth over $25.8 million by 2021. So the key is the right place to invest. Number 2, financial roadmap. Before you start, sit down and start making a financial plan, especially if you haven't invested yet or you don't have a financial roadmap. You can create your own financial roadmap or get the help of an expert. This will give you an idea of how much money you have to invest or how long you have to keep your money in stock. By having knowledge and a roadmap about facts and figures about the market and planning about saving and investment, you can manage your money in good ways. Number 3, get familiar with filings. While a few financial backers may feel that they have an intuition of tracking down great organizations, most of us need to get our work done. That is everything you could manage. One of the best places to start is the customary filings public organizations made with the SEC, which are needed to detail everything from organization funds to expected struggles and hazard factors. All filings for US public companies and foreign companies that list the US exchanges can be found online. Number 4, price to earnings ratio. Let's say, for example, you made an investment plan and now you want to hire a financial advisor so that he can take care of your investment. You interviewed 2 financial advisors. One of them has a lot of experience with a great background in stock market, while the other one is just stepping into the business and looking for clients. The one with experience offered you 40% prices to earnings ratio, which means out of $1 you gain from investments, 40 cents will go to the advisor and 60 cents to your revenue, while the second one is offering you just 20% to keep and 80% will go into your accounts. Keep in mind the example. The price to earnings ratio, or P/E ratio, helps you compare the price of the company's stock to the earnings the company generates. This comparison helps you understand whether markets are overvalued or undervalued a stock. If an organization's stock is buying and selling at $100 in step with percentage, as an example, and the business enterprise generates $4 in keeping with proportions in annual earnings, the P/E ratio of the company's inventory might be 25 or 100 over 4. To put it another way, given the company's modern income, it might take 25 years of gathered earnings to equal the value of the funding. So always consider the price to earning ratio before making decisions about investment. If you still have questions about the price to earnings ratio, let us know in the comments section and we will make a separate video on it for you, and subscribe to the Money Masters to get notified for the upcoming videos. Number 5, dividends. The word dividend comes from the Latin word dividendum, things to be divided. A dividend is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit or a surplus, it is able to pay a proportion of the profit as a dividend to shareholders. Any amount not distributed is taken to be reinvested in the business, called retained earnings. Public companies usually pay dividends on a fixed schedule, but may declare a dividend at any time, sometimes called a special dividend, to distinguish it from the fixed schedule dividends. Dividends are the best part of a company to consider whether you should make an investment or not. Just analyze the company's dividend ratios in past years. If a company is distributing profits frequently among shareholders, this is an indication that the company's shares are making good money. Number 6. Sell a loser share. There is no guarantee that a share will be at its peak again after a recession. You should be realistic about the behavior of shares performing badly. You might think it's a losing point to sell your shares because of decline, but you should sell those shares to prevent further losses. Poor performing shares can harm your portfolio and investment mindset. Just sell those shares and move ahead. Number 7. Taxes. Investment in stock can make you rich, but it is important to understand how investment on stock can affect your tax bills. Capital gain tax. A capital gains tax is a tax on the profit realized on the sale of a non-inventory asset. The most common capital gains are realized from the sale of stocks, bonds, precious metals, real estate, and property. Taxes on dividends. Dividends are usually income with taxes. Qualified dividends and no qualified dividends. Taxes on qualified dividends are similar to the taxes on your income, while taxes on non-qualified dividends depend on your filing status and taxable income. It can be 0%, 15%, or 20%, usually lower than qualified dividends. Number 8. Tips. Regardless of tips and trick suggestions by investors and advisors, always do your homework before starting your journey into the stock market. Tips can be effective, but for long-term growth, you should be depending on research. Number 9. Emotions. Most of the investors lose their money just because of inability to control their emotions. Fear and greed are the most important factors to control. Usually people jump into the stock of unknown companies due to rumors about huge gains without actually understanding the risk involved. As a result, they lose everything instead of making profits. Second most important factors to consider is don't panic. Usually when shares of good companies go down a little bit, investors panic and start selling them. Investors should wait a little longer to make better judgments and decisions about selling or not. Number 10. Experts. Financial expert or a financial advisor is a professional who provides financial services to clients based on their financial situation. In many countries, financial advisors must complete specific training and be registered with a regulatory body in order to provide advice. Always keep those financial advisors around you before making any decisions. Subscribe to the Money Masters and keep us around to guide you in future investments. If you have any questions about investments, put those questions down in the comment section below. If you have feedback about the video, let us know as well. See you with another great video. Until then.